Hello and welcome to the Roundup. We'll cover what's important to accountants and advisors across the month of September. Inside this edition, we'll be taking a look at the actions the ATO is taking on profits of professional services firms. We'll also look at the new guidance on how the CGT rules apply to non-residents. But first up, Michael Carruthers is going to take you through Section 100A. Michael, we've got some new material released from the ATO. What can you tell us about that?
Yes, that's right. Now, first of all, what the ATO has done is released some very brief guidance, but really all that guidance says is that the ATO is working on finalising the draft materials that it has already released on Section 100A and having those ready by the end of the year. Now, I think the ATO means calendar year, but we'll wait and see. Now, leading up to that, and as part of, I guess, providing more information to taxpayers and practitioners, the ATO has also explained that they're going to be adding in more examples into the finalised version of the guidance. And prior to us getting the final version of the guidance, the ATO has given us 5 additional draft examples for public consultation and comment that they are thinking about adding into the final guide. Now, each of these 5 draft examples deals with what the ATO refers to as green zone scenarios. These are low risk scenarios. You wouldn't expect the ATO to apply compliance resources to scenarios like this. Now, there are a range of different scenarios. They're all a little bit different. A couple of them deal with scenarios that we've actually had posed to us quite a lot over the last few months since the ATO released its original draft materials earlier in the year. For example, you might remember that in the original draft guidance, the ATO in its red zone scenarios,
and Mike, with these, what sort of expenditure qualifies for these
distributions to loss entities
and
could potentially be classified as high risk. Having said that, the ATO did say that distributions to loss entities would only be classified as high risk if there were certain features. And really it was all about appointing income to a loss entity, but where the funds were never actually paid across or applied for the benefit of that loss entity, which kind of suggested that as long as the funds were paid across and enjoyed by the loss entity, we probably wouldn't have a high risk scenario, assuming none of the other high risk features were present. Well, some of these additional draft examples deal with distributions to loss entities and show the sort of scenarios that the ATO would consider as being low risk. And that really is demonstrating that the real benefit of the funds has been provided across to the loss entity. And that could mean, for example, let's say a loss entity is appointed some income, either we're physically distributing the cash across to that loss entity, or we are paying off liabilities of the loss entity for its benefit. So the loss entity may owe amounts to other parties. We could either give the money to the loss entity, which then pays its liabilities, or we could have the trustee directly pay those third parties to satisfy liabilities owed by the loss entity. Either way, the loss entity is receiving the real benefit of the income that's been appointed to it. So there's a couple of those scenarios which deal with loss entities, which is quite nice that we have a little bit of comfort, or starting to get a bit of comfort around distributions to loss entities. The ATO is demonstrating that just because you appoint income to a loss entity, it doesn't necessarily mean you've done anything wrong. One of the other scenarios also deals with a business which is operated by individuals across generations. And again, for some people, that's kind of a feature of their business arrangements. And again, the ATO is demonstrating how sometimes those arrangements would still be considered low risk, even though they didn't necessarily fit within some of the examples in the original draft guidance. So I suspect that for some people, these examples will certainly provide a bit of comfort. Remember, of course, they're in draft form, and we're hoping that there will be more examples provided on top of these ones.
Some of the materials from the ATO seem to suggest they're using a 2-year time period. How does that work?
Yes, so the examples, these additional draft examples that the ATO has given, is suggesting that the ATO is working towards effectively what you might call a 2-year safe harbour. So one of the most common questions we've had over the last few months around Section 100A is, look, we know that Section 100A is aimed at situations where income is appointed to a beneficiary, but the real benefit of those funds is basically enjoyed by someone else. How long have we got between appointing the income and providing the real benefit to that beneficiary before we have a Section 100A issue? And the short answer to date has been, we don't really know. Certainly if we have distributions being owed to corporate beneficiaries, there's Division 7A issues, and there's some quite specific timeframes for managing those problems. But when it comes to, say, individual beneficiaries, trustee beneficiaries, there's really been a big question mark over what sort of time period would be acceptable and what sort of time period would be potentially running into problems. Well, what the ATO is suggesting in some of these more recent draft examples is that if the benefit is provided to the beneficiary within 2 years of the income being appointed, then that would generally be considered a low-risk arrangement or scenario. Now that assumes that there aren't other high-risk features that are present, but on the face of it, a 2-year general time period. Now that's not in the legislation. This is simply the ATO saying that they're probably not going to look to apply Section 100A from a practical point of view, where we have appointment of income happening, distributions or benefits being provided within 2 years. Now the really important thing to note there is that just because income isn't paid across or benefits aren't provided to the beneficiary within that 2-year period, that doesn't automatically mean that Section 100A has been triggered. It simply means that you've kind of gone past that kind of safe harbour point, and the level of risk associated with the arrangement is probably just going to be that little bit higher. You would then be looking at, well, why is it taking that long? What other features are present in relation to that arrangement? Because it might be that it's still a low-risk arrangement, it's just being dealt with under another specific way. For example, the ATO guidance already deals with retention of funds in the trust for use as working capital, that sort of thing, and there's no time limit to how long that can occur. So just be a little bit careful about what we read into that 2-year time period. It's effectively a safe harbour. If we kind of manage it within that 2-year time period, are very unlikely that the ATO is going to seek to apply 100A. Beyond that, we need to start looking at the arrangement in a bit more detail.
It's been almost a year since the ATO finalised that fairly important guidance on allocation of profits generated by professional services firms. Matthew, since then, has the ATO indicated what actions they'll be taking?
You're absolutely right, Lisa. It's almost been a year since the ATO finalised what were some pretty important guidelines on the allocation of profits generated by professional firms. Now, they were quite contentious when they were first initially released and finalised, so we have covered them quite in depth in our previous updates and our previous webinars. So hopefully most of you will be familiar with those guidelines. So without necessarily going into too much detail, it is still actually worthwhile outlining what these guidelines are trying to target. And they're trying to target professional firms. As opposed to firms that generate income from someone's personal services, where the rules are actually much more strict, they're targeting firms that generate income mainly from a business structure. So think firms with employees or firms with some business goodwill. And the ATO's concern there really is that a disproportionate amount of those firms' profits are being diverted away from the individual principal practitioner owner to their related parties, ultimately with the aim of reducing a tax liability. Now, the ATO says that can still be tax effective in some circumstances. However, they are also saying that there are reasonable limits to how much profits can be diverted away from that individual principal practitioner before you move into anti-avoidance territory. And the way the guidelines work is that you'd firstly need to check and ensure that there is a commercial rationale for the structure, for the arrangement, and the way the profits are distributed. You then also need to ensure that there are no what the ATO calls high-risk factors present. And the ATO guidelines do give an example of these high-risk factors. And it's really only then that the individual principal practitioner can self-assess themselves against up to 3 factors or 3 benchmarks, if you will, to determine their score. That score then determines whether they're seen as low, medium, or high risk in the eyes of the ATO. And that risk rating then determines how much ATO attention that they're likely to receive. That's not new, but what is new is that the ATO has just recently announced this month that they're going to start contacting individuals who might be in that high risk category just to better understand the arrangements in a bit more detail and provide some guidance on how they might move towards that lower risk zone. That shouldn't come as a surprise. Those guidelines were finalised almost a year ago now, and there was almost the expectation that the ATO would become more active and start moving towards the next phase of contacting taxpayers about their arrangements.
If practitioners haven't turned their mind to these guidelines as yet, what should they be considering right now?
Well, those guidelines are now live, and they did come into effect from 1 July 2022. So for most clients, the 2023 year. Having said that, there can be a transitional period, and there actually can be a bit of leeway, at least for some clients. In particular, for those individual principal practitioner owners that were considered low risk under the previous suspended guidelines, but are now considered medium or high risk under the now finalised guidelines. The ATO has given them an additional 2-year transitional period, so up to and until 30 June 2024, to move themselves into that lower risk category. But really, if you haven't already, now is really the time to work out which clients are impacted by these guidelines, and for those clients, try to work out and model out what their risk rating would be. And importantly, have that discussion internally if you're a professional firm and with clients that are professional firms around that risk rating and what that risk rating means in terms of ATO attention, especially if they aren't in a low risk zone but want to be. I wouldn't necessarily be waiting for the ATO to get in touch. I'd be thinking about the things and the levers you might be able to pull to move them into a lower risk category for the 2023 year.
Over the last few years, there have been a number of changes to how CGT rules apply to non-residents, but there's still a lot of confusion about how these rules work in practice. And in response to that, the ATO has released new guidance. Michael, what are the issues and what do we need to look out for?
Yeah, so the government over the last 10 years or so has really worked pretty hard to strip away CGT concessions for non-residents. And the two big ones are the CGT discount. And so 2012 was when we had some pretty major changes around the CGT discount rules. And then more recently, the main residence exemption. Now, a lot of people realise, I guess, that there have been some changes made in the system around the CGT discount and the main residence exemption, particularly when it comes to non-resident taxpayers. But we find there's a lot of confusion in terms of how you actually apply those two rules in practice or those systems in practice. Let's start with the CGT discount. You can still access the CGT discount even if you are a non-resident at the time of the CGT event. The way the CGT discount rules tend to work is that your ability to access the discount isn't so much affected by your residency status, but the discount percentage can be. So if you have been a non-resident or a temporary resident at some point across the ownership period of the asset, then you might still qualify for the discount, but the discount percentage might be less than 50%. And in some cases, it might be 0%, so you don't really get the discount. So it's not necessarily your residency status at the time of selling the asset that is crucial. We're looking at your residency status over a period of time, and it will influence the calculation of the CGT discount. Now, that's where things get a little bit more complex because there are 4 different formulas to work out what your discount percentage is, and it really depends on when you bought the asset and what your residency status was at various points in time. Now, when we go to the main residence exemption, again, the government has kind of stripped away that exemption for non-residents, but it works really differently to the CGT discount. In this case, the main residence exemption is focusing on your residency status at the time of the CGT event. If you are a non-resident at the time of the CGT event, then you generally won't get the main residence exemption at all. There are only very limited exceptions to that. You need to have been a non-resident for 6 years or less at the time of the CGT event, and certain life events need to have occurred while you were a non-resident. And that could be death of a close family member, terminal illness of you or a close family member, relationship breakdowns. So reasonably nasty sorts of things that might have happened to you or your close family need to have occurred while you were a non-resident. On the other hand, if you are a resident of Australia at the time of the CGT event, then you can basically apply the main residence exemption as you would any other time. The fact that you might have been a non-resident for some of the time pretty much makes no difference at all when it comes to the way you apply the main residence exemption. Now, changes in residency status can have other flow-on impacts. Sometimes that can reset the cost base of an asset. You can have deemed CGT events when you cease to be a resident. So things are a little bit more complicated than that. But it is important just to understand that while restrictions have been placed on accessing the CGT discount and the main residence exemption for non-residents, those two things work very differently. And it's important that we don't get confused between how those two operate because the numbers are often very significant. And clients often need to know this stuff before they make a decision around what they're going to do. For example, if you've got a client who's decided at relatively short notice to move overseas and they still hold on to their Australian home, understanding the impact that these changes might have on their tax position in Australia might significantly influence the decisions they make around when they go and what they do with their property. So really important for clients to be fully informed and they understand the ramifications of major decisions that they're going to make.
And that's the roundup for this month. If you're not a member of Knowledge Shoppers yet, we'd love to show you how we can make a difference to your practice, whether you're in accounting or whether you're in financial services, and how we can make life in professional practice just that little bit easier. Give the team a call. We'd love to show you what we have on offer and how we can make a difference to you every single day. Speak to you soon.